Do you ever wonder whether a lump sum investment or dollar cost averaging in over a period of time will give you a better return on your investment? Well, I've gone away and I've done a 6-month experiment looking at investing into an all-world replicating portfolio which consists of 4 different Vanguard ETFs. So let's go and see which one has performed better. And if you're new here, hi, I'm Mark of Desperately Seeking Fi. So how have I set this all up? 6 months ago, I went, right, let's try and pull together a portfolio that basically replicates VWRL. So what I've done is I've invested into the US, the emerging markets, UK and Europe, excluding the UK. And the 4 different ETFs that I've used are VUSA, VFEM, VUK, and VERX. If you have a look at them on the screen, you will see that I have weighted them and just invested into them. And the way that I've invested into them is I'm putting £307 into that monthly dollar cost averaging. So that's more my lump sum idea. And then looking at £10 per day. And that will average out over the year at approximately £307 per month. So I have literally just set this up on Trading 212 in a couple of different pies, and if you want to go and have a look at those, you can have a look down below where I'll link those in. And if you aren't already using Trading 212 as your investing platform, there's also a link down there where you can get in and get a free share for investing anything as little as £1 onto the platform. So what do we really think is going to have happened when we look through this? In the previous video that I've done on lump sum versus DCA, they are basically talking about if you are in an upwardly moving market, it is likely that that will be the lump sum at the very beginning. I also had another pie that I was investing into before I even started this. So that is my Own the World, and that's because I've invested across those 4 different areas using the 4 different ETFs. And I stopped investing in those to switch and start investing into the monthly and the daily DCA pies. So we'll be able to see whether or not that lump sum that I put in there is actually going to be the one that is leading the way in returns. So shall we go on these in reverse order, or shall I mix it up a little bit? Let's start off with the monthly DCA pie. So in the monthly, I've got those 4 ETFs, and if we look at it, we actually get to see how the different ETFs have actually performed over that time period. In this monthly pie, we have seen VUSA go up by 9.66%, emerging markets by 2.14%, UK by 1.93%, and then 6.13% increase in VERX, the European ETF X UK. Let's chuck in that Own the World pie that I had. So this is the one where I had invested we will call it a lump sum, because when I started this experiment 6 months ago, the Own the World, I stopped investing in it. So in reality, it was a lump sum amount of money in there. It has gone, seeing the US go up by 15.39%, emerging markets by 2.04%, UK by 2.92% and Europe by 6.16%. On the daily DCA pie, which is £10 per day, just going in, and there is one slight difference with the way that this works because you can't trade on the weekends. It is £10 goes in Monday, Tuesday, Wednesday, Thursday, Friday. At opening bell, that literally just gets invested into the ETFs. I pay the price that it is when the markets actually open, but the Saturday and Sunday investments, they get paid in on a Monday morning. So in reality, I have £30 paid in, but they sometimes go in at slightly different times as the markets open on Monday morning. On the daily DCA pie, we are looking at the US is up 8.67, emerging markets by 2.43, 1.63 on the UK, and On the European side of things, 5.37. So if we are to rank these in the bronze medal position, you would have overall the daily DCA comes in third place with an increase of 6.17%, monthly up at 7.41%, and the Own the World, so the lump sum, at 9.07. So what can we take from all of this? I think what we can take is that if you are in a upwardly progressing market, i.e. it is rising, you will be better off with that lump sum being paid in. And that's basically what I talked about in the previous video. On average, if the markets are going up, you are better off with that approach. But if you look at some of those ETFs, you actually see that on the daily DCA, we had the emerging markets was performing better on the daily DCA, and it was worse performing on the Own the World, so that lump sum being in. Let's have a quick look at the chart and see why that might be. And if we have a quick look at the VFEM over the last 6 months, what has that been doing? It's been up and down quite a bit. So by doing that daily purchase in, I've been buying when it has particularly been down at its lower points in November and then yet again towards the end of January. If you have a look at what has been going on in the US market in the S&P 500, it's been a gradual increase in price over the whole time period, with that going up 15%. So there haven't really been any dips for you to be buying into, which is where that daily DCA picks up lower prices and then gives you a lower average, which then in reality gives you a slightly better performance than you would do on that monthly or Own the World. So I hope that has been of interest. Why don't you go and have a look at this video where I talk through some of the higher dividend paying stocks that we have here in the UK. Thanks very much for watching, and I will see you in the next one. Cheers, bye.